Very good evening to everybody. We have something very interesting even after my session. I've come here to explain some concepts to you about debt. Is As compared to equity, most mutual fund distributors, we find debt little more complex and confusing. Am I right or wrong? Session which clears concepts about debt, because even I have the same challenge like you have. It's not just you have, but I'm trying to help myself also. And in that process, I'm trying to help you with some basic concepts. Also, debt ka role kya hai? Debt is, we say it is a asset class which gives 7% return, 6% returns. Okay, is that the only role of debt? Is that the reason we should put money in debt mutual funds? How is debt mutual fund different from fixed deposit? Let's say even in fixed deposit, the person is putting less money and he is 10% tax bracket. In that case, also debt can be different from fixed deposit. And what is the relationship of debt with equity and how does that work? So I am going to make an attempt in about 10 slides to give you some clarity in this. Okay, so I hope I am able to succeed. So here it is, the real purpose of debt and how you, for an MFD, how it can give you a lot of power. So I'm starting with some very basic stuff, which is the whole purpose of this presentation. And I am starting with the equity side of it. So a company is there, it has to mobilize money for equity. Let's say the company's earnings are 100 rupees, uska PE is 4, तो 400 रुपये में वो शेयर बेचता है. और जब 400 रुपये में शेयर बेचता है, अर्निंग इज 100, तो अर्निंग डिवाइड बाय प्राइस इज 25%. मतलब 100 for a 400 rupees purchase is earning 100 rupees. That is 25%. मतलब 4 साल में वो 400 रुपया कमा लेगा. But if the demand for this particular share increases, okay, and more buyer want to buy it, let's say buyers want to pay 800 rupees. Okay, then automatically your yield will come down, because for every 100 rupees that I am earning, I am giving 800 rupees. It's a 12.5% yield. This is a basic thing all of us understand, should not be a problem. Obviously, the buyer is losing because he's buying at a higher price. Okay, so in the secondary market, what happens? In the secondary market, people go and they can bid at a higher price, which happens all the time. And therefore, when the prices go up, yield comes down. So even if a company is giving a very good performance, good earnings, okay, it doesn't mean that you are benefiting by that if you're buying at a high price. So you can buy that. That's the reason we need to consult fund managers and we need to go to experts. Because if you buy the best company at a very high price, you may not make any yield, may not make any money. Is this clear to all of you? Can somebody put in the chat box? This should be very clear. This is a straightforward thing, right? So basically, when the demand goes up, the price goes up. When the price goes up, the yield comes down. Okay, and when the yield comes down, and as the price keeps going up, the buyer is losing more and more. Okay, so during a bull market, actually, if you are buying, okay, at a high price, you are not going to earn too much. Okay, so this is the first thing. Now, the same concept is also applicable in debt, but in debt it gets a bit complicated. So I have tried to make an example of a different product so that you understand the concept. So debt में भी ऐसा ही होता है कि we always say in debt that whenever the interest rates come down, the NAVs go up. Okay, and whenever the interest rates go up, the NAV comes down. Prashant Trahate, my voice is okay, I think, because others are not having problem. So NAV, so most of us remember it by heart. Okay, do you agree that we remember it is like, a formula? मतलब interest rate घटेगा तो NAV बढ़ेगा और interest rate बढ़ेगा तो NAV घटेगा. Okay, ये like a formula हमको सिखाया गया है. No, slide doesn't change now. I am not changing the slide. Don't your mind is working faster than your ears right now. Please listen to me. आगे का slide जान के क्या करोगे आप? सुनो पहला. Okay, so are you getting my point? So is it true that most of the time we remember it like a formula, that when the interest rates go up, NAVs come down, and interest rates come down, NAVs go up? Do you agree that most of the time it is just something that like a formula we remember? Is this a little bit of a complex concept to understand? So we remember it like a formula. Okay, so today I will try and clarify this particular formula using a different product example, coming back to debt, and then talking a little bit more about debt after that. So now here, if you say, I am just giving you a different kind of an example, okay, where I have taken the case of a, now don't go by rupees 100, don't go by the numbers. I have put very large numbers so that it is easy to understand and comprehend. Okay, so I have said that here there is a bread called Wibs, and the price is 100. Okay, and when it is now, I'm just going to make this small change which I had done in a different slide. Just one second. So just instead of rupees 20, you assume that there are 20 units of protein in it. There are 20 units of protein in the bread. Okay. When I sell it for 100 rupees, it is like a yield of 20%. For I'm getting 20 units of protein for 100 rupees. Is it clear? Now, I should have changed this, but this in another slide I've changed it. But here you don't treat it as rupees, treat it as protein units. Okay. Now the demand goes up. Market loves this bread. They are willing to pay 200. So at 200, how many units of protein are they getting? Yeah. So whenever the price also goes up, the units of protein remain the same. So at 200 rupees, I'm again getting 20 units of protein. So my yield is coming down. The buyer का पैसे से उसको कम मिल रहा है. उसका yield कम होना मतलब he is not getting enough. पहले ज्यादा मिलता था because price बढ़ गया, उसको कम मिल रहा है. He is getting same 20 units protein, but he is paying 200 rupees more. So what happens? Supposing everybody starts going and buying debt funds right now because Vijay Mantri sir has said that you buy debt right now because we think that 80% of the interest rate cycle has already got over and maybe very soon the cycle will turn. And when the cycles turn, मेरे को और भी appreciation मिल सकता है. Okay, so but if the demand goes up like that, if everybody starts buying, then the price also goes up. So is this clear, this part of it? So let's go to the next slide. Here I had made the change. Here now assume there is a food regulator. Assume there is a food regulator who suddenly says that, you only need 10 units of protein in your bread. You don't need 20 units of protein. Which means that besides this one manufacturer, that is, jo bana ke pehle rakha tha, let me just, besides this guy, now what happened? All the new guys in the market are going to sell at 100 rupees, they will sell 10 units of protein in their bread. Okay, because the regulator has said you can come down. So it is like the yield interest rates coming down. Now, what will this guy do? Will he sell his product at 100 rupees? Because अगर वो 100 में बेच रहा है तो वो 20 units दे रहा है. But now market में सब लोग 10 units ही बेच रहे 100 रुपया में. So how much will he charge now? Yeah, he will charge 200, right? No, obviously. See, अभी क्या है कि when he is selling it, he is selling out in his packet there are already 20 units of protein. The market is selling 10 units of protein because the regulator said 10 units चलेगा. So 10 units of protein market 100 रुपया में बेच रहा है. तो उसके पास 20 units already है अपने पैकेट में. तो वो मार्केट में महंगा बेचेगा. He will sell it at 200 rupees. He will sell his at 200 rupees because the food regulator has got it down to 10 units of protein. So now what has happened, what we are saying is, when the food regulator ke jagah pe, when you have the Reserve Bank and they say interest rates will come down, your NAVs go up because you are selling it to somebody. You are a seller of debt at that time. You have bought it earlier and you got an NAV, but now you are a seller of debt. So why are you selling it at a higher price? Because the yields have come, the interest rates has come down in the market by the regulator, by RBI. Is this clear? This is very important to understand. This is what I was trying to grapple with all the time to make it simple. Have you all understood it? So this, tomorrow you can go to your client and you are explaining him debt funds. You can explain how price appreciation takes place. You can tell your client that we are buying units right now Tomorrow we will be seller of units. And when the interest rates come down, I can increase the price of my unit, or basically the market itself will increase. My NAVs will go up. NAVs will go up because मेरे पास 20 units of protein है, but market बोलता है 10 units में charge कर सकता हूँ 100 रुपया, तो 20 units है तो मैं प्राइस ज्यादा ही चार्ज करूंगा. तो जो नया बायर होगा उसके लिए लॉस हो सकता है, बट मुझे फायदा होगा. Okay, so this is now, let me continue this in the real scenario. Now what happens here is you have debt mobilization, you have coupon of 10%. You could have a price of 100 and then your yield is 10%. If there are too much of demand, तो automatically 200 rupees अगर हो गया प्राइस तो yield कम हो ही जाएगा. उल्टा अगर कल मॉनेटरी पॉलिसी की वजह से वो लोग बोलते हैं कि इंटरेस्ट रेट को 5% रखना है, तो वही 5% अगर अपने को कमाना है तो we don't need to sell it at 100 any longer. We can sell it at 200 now because the regulator has said is only the interest rates have come down to 5%. So the interest rates have come down to 5%. What is 5% of 200? Okay, so that is how the same example that I gave you here is what is playing out over here. Is this clear? Why is it that the NAVs go up? यहाँ पे 10 on 100 था 10%, यहाँ पे 10 on 200 हो जाएगा because 5% ही करना है तो मेरे को 200 रुपया तक प्राइस रेज करना पड़ेगा. तो अगर मेरा 100 रुपया है तो आई एम अ फूल टू गो टू द मार्केट एंड सेल एट 100 rupees because the market will buy 200 rupees. It is very similar to the previous example, but this is what really happens. When interest rates come down, whatever units you are holding, you have to sell it at a higher price because the new buyer has to earn less yield. Because that is the prevailing rate in the market after the regulators take made a. उसके बाद जो नए coupons आएंगे सब 5% पे ही आएंगे. So regulator has changed the scenario. New products are available at 5%. मेरे पास 10% product था, तो अगर मुझे मार्केट में बेचना है तो मुझे उसकी प्राइस बढ़ानी पड़ेगी, तो मुझे फायदा होगा, बायर को महंगा मिलेगा, बट मेरा, तो दिस इज कॉल्ड एप्रिसिएशन ऑफ प्राइस बिकॉज आई एम ट्राइंग टू गिव द बायर ओनली 5% यील्ड. पहले मुझे बायर को 10% यील्ड देना पड़ता था, अभी में 5% में काम हो सकता है. तो मेरे को अगर 5% यील्ड ही देना है एट अ 10% प्रोडक्ट, द अदर आइदर ब्रिंग इट डाउन टू 5% और इंक्रीज द प्राइस टू 200. इज दिस क्लियर टू एवरीबडी? सो यू कैन यूज दीज स्लाइड्स with your clients to make them appreciate how appreciation happens in debt fund, which doesn't happen in FD. Okay, and how it happens, you can take these slides and you can talk about it. Now, let me take you to the next slide, which is again very important. Now, in case of a bank, what happens? You have 500 rupees, 10%, you may make 50%, 10% yield you'll make. And once your fixed deposit term is over, you get your money back or you again roll it over. But you don't get a chance to sell the units to the bank. It ends over there only. So you are only a buyer of debt. You are never a seller of debt when it comes to FD. So understand that when you are in the mutual fund market, you are in the market, you buy and you sell. You also have an opportunity of sell. Of course, you can sell at a loss also. But हम लोग अगर म्यूचुअल फंड डिस्ट्रीब्यूटर्स हैं, तो हमको इतना तो पता होना चाहिए कि मार्केट का इंटरेस्ट रेट साइकिल ऊपर है या नीचे है. ओके, वी कांट बी सो नाइव दैट हमको कुछ नहीं पता. ऑब्वियसली अभी इंटरेस्ट रेट साइकिल हाई रह चुकी है, काफी टाइम से रह चुकी है, आगे चल के साइकिल टर्न होने वाली है, तो वी विल ऑलवेज टेक अ प्रूडेंट डिसीजन. दैट इज द रीजन इन्वेस्टर कांट डू दिस हिमसेल्फ, ही नीड्स टू कम टू अस. सो वी कैन टेल हिम दैट ठीक है, अभी आप डेट में डालो, आपको अप्रिसिएशन मिलेगा, बिकॉज वी आर गेटिंग अ चांस टू सेल. Okay, in a bank you can't do this. Okay, mutual fund company जो होता है, they always repurchase. Okay, mutual fund companies always repurchase from us. So in a way we are selling it to them. We don't go to the open market, they only repurchase it from us. Is this very clear that in a debt fund you get a chance to sell, there is a capital appreciation. I explained to you how the capital appreciation takes place, either by the demand of people, they are buying at a higher price, NAVs go up, or if the regime changes and the yields come down, then I have to sell at a higher price because the new buyer has to get a lower yield. And second thing is this buying, selling can happen with the mutual fund units. I cannot do that with a bank fixed deposit. Is that clear? Do you think you can use these slides to educate your clients? Or do you think you would like to use these slides to educate your clients? And once you educate your clients on debt, they will be far, far more open to consult you. They will know that you know more, and they will definitely want to not take decisions themselves, because ये complex, ये इतना complicated है कि हमको ही समझने में time लगता है. तो imagine client को क्या समझेगा? Okay, that is when the client will respect us. And also we should we should have knowledge about the interest rate cycles, which we always have. Okay, so we can definitely bring some distributor alpha in the client's life. So this is one part of my explanation on debt funds, that in debt funds, not only you can lock your money at a higher interest rates during this period of time, but when you put your money at this period of time, and let's say the interest rate cycle is not over, and in the next cycle, your interest rates further go up a little bit, then you may suffer little bit of a NAV loss in the short term. That is the reason you can't do it for 1 or 2 months or 3 months. But if you are sure that 80% of the journey is kind of over, 90% of the journey is over, and the cycle will turn, then in the long term, you will get lot of appreciation in the NAV, as well as you have already locked in at a decent accrual interest rate. Because at a higher coupon, higher yield, you have locked your money, number one. Second thing is the cycle will turn. Okay, appreciation bhi hoga, acha return bhi aayega from the yield that you have locked in. So both these things are happening. Okay, so there are two things. And a bank में आप एक ही चीज कर सकते हो, आप seller नहीं हो, हमेशा buyer ही हो debt पर. Here you are also seller. You are selling units and making money. So this is a very important part. So let me explain to you some more things about debt funds. When you know the higher interest rate cycle could come to an end, as high interest rates have prevailed for a long time, you can invest at a reasonably high yield. Point number one, I told you, don't need to worry too much about future interest rate rise. There may be a rise here and there, one more rise, but don't worry, you're there for a longer term. Your NAV may for a short period even come down, but hence it should not be a short-term investment. But when cycles turn, which we expect to turn with our knowledge, the NAVs are going to rise and there will be price appreciation, and accrual income will happen because you anyway locked at a very reasonably good yield. Okay, two incomes from debt, that is accrual income plus appreciation. In fixed deposit, only one. Very clear, friends? Okay, now let me talk about debt plus equity funds. The purpose of the blend between debt and equity is not averaging out or just averaging the volatility. One part is averaging the volatility standard deviation कम होगा क्योंकि आपका जो प्रोडक्ट है उसमें स्पीड ब्रेकर लगाया गया है. In your equity is a car, debt is like a shock absorber, like a shock, and the volatility is like a speed breaker. तो गाड़ी चल रही है, अच्छे शॉक अब्जॉर्बर है, आगे स्पीड ब्रेकर है, गाड़ी फास्ट जा रही है. अगर आपके पास डेट है तो आपको झटके कम लगेंगे. That is one of the reasons to mix the two, debt and equity. So the purpose of the blend is not just averaging or not just what I told you right now. There is a huge opportunity in volatility. So when markets come down, the client may not be in a mood to put more money. Normally कोई भी client इतना खुश नहीं होता है जब market टूटता है. Okay, उसका sentiments down होता है, हमारा भी sentiments down होता है. ये टाइम में फोन करके क्लाइंट को बोलना भी कि सर आप ज्यादा पैसा डालो, itself is not very easy, and many clients may not be willing to put more money when the markets come down. So debt fund at this time acts like a reservoir of cash. अगर debt fund है पोर्टफोलियो में तो आपको क्लाइंट को बोलना है कि ये टाइम में ये करना चाहिए फ्यूचर के लिए. It is a job to be done. Okay, and then you do a switch. Now this is the big rebalancing opportunity you are getting unless you have debt fund in the portfolio. आप करोगे कैसा? आप फोन करते रहोगे क्लाइंट को कि पैसा दो, वो देगा नहीं देगा और मार्केट रिकवर भी हो सकता है. So to give you what can happen. So if the markets were to drop by 20% and you have cash to put, that cash, even if the markets come back to the same level, it will have to go up by 25%. Or if the markets come down by 10%, it has to go by 11%. आजकल के दिन में कई बार मार्केट 10% के ऊपर गिरते हैं और वो रिकवर भी हो जाता है विद इन 1 month. Many times market fall by 10%, they recover also within a month, right? So when they recover within a month and they recover 11% within a month, that means you are getting nearly 10 to 11% recovery within a month, which is equivalent to a 120% return. Am I right? Because you took that decision and market actually recovered in 1.5, 2 months, you are nearly getting at the rate of 100% return, but your whatever money you have put within a month, it has gone up by 10 to 11% or 12%. Now, look at the role of debt. Is debt only playing a role of 6-7% return? Can you answer? Is debt only playing a role of 6-7% return? Is it only a substitute to FD? It is giving you capital appreciation opportunities. One. Second, it is giving you the opportunity of rebalancing. And when you do rebalance, and markets are so volatile, so range bound, they keep coming down by some 10%. They will rise up again, maybe in 1 or 2 months. You again make money. This is how you are creating distributor alpha for the client. So this is, there is also a calculator which I'll show you. I had already shown in one Pathshala. So debt opportunity. So ट्रिपल ए जैसा ट्रिपल ए पेपर सबसे बेस्ट होता है ना, ट्रिपल ए रेटिंग बोलते हैं ना, मैंने ट्रिपल ए बनाया है डेट फंड का अपॉर्चुनिटी. ट्रिपल ए, वन इज एक्रूअल इनकम, सेकंड इज एप्रिसिएशन इनकम, एंड थर्ड इज एसेट रीबैलेंसिंग इनकम. This is the reason why today dynamic asset allocation fund, along with all the technology that they have, they can scale up rebalancing. पहले rebalancing scale up नहीं हो सकता था इतने लोगों के लिए. Today, because of technology, it is very easy to rebalance for multiple people. Okay, so therefore dynamic asset allocation fund has grown into a huge category. We can't afford to keep debt out of the action of a portfolio. We cannot do that. It acts like a shock absorber and keeps the car in a healthy state. You also travel fast, and when your back is intact, and also when your car is intact, अगर आपका पीठ भी ठीक ठाक है, शॉक अब्जॉर्बर से चोट नहीं आई है, और अगर आपका गाड़ी भी अच्छी कंडीशन में है, तो आप फास्ट भी जा सकते हो और आपको झटके भी कम लगेंगे. So best of both the worlds with debt fund is like sugar in tea. If portfolio is tea, debt fund is sugar in it. It plays the role more than 6%, 7% return वाला से ज़्यादा काम है debt fund का. And that is the purpose of today's presentation. With this, I have come to the end of my presentation. I will just show you the calculator, a simple calculator that I have. Yeah, I had shown this calculator earlier also. See, whenever the markets, let's say you can say the markets fall by 15%. The markets fall by 15%. To reach the same level, they have to rise by 17.65%. If it happens in half a year, 6 months, your return is 38% CAGR. Okay. If it happens in, let's say, in 1 month, or like let's say 0.1 year, this is your return. If it happens in, let's say, 0.9 months, that's about 10 months, this is your return. So if it happens in 2 years, then this is your return. Okay, so this is a very interesting calculator. You can share this with your client to explain to him why debt is such an important category. It does much more than what we believe it does. So with that, I have finished my presentation on time.